$47 billion. That's what WeWork was worth in January 2019. More than Ford Motor Company, more than Delta Airlines, more than Marriott International. And 47 days later, it was all gone. On August 14, 2019, WeWork filed paperwork to go public. By September 30th, the IPO was dead, the CEO was out, and the company's value had collapsed by 83%. But here's what makes this story different from every other startup failure you've heard about. When it all fell apart, founder Adam Neumann walked away with $1.7 billion. Meanwhile, 2,400 employees lost their jobs. This is the story of how one charismatic founder convinced the world's richest investors that a real estate company was actually a tech unicorn. And what happened when Wall Street finally looked behind the curtain. So let's go back to the beginning. In 2010, Adam Neumann and Miguel McKelvey founded WeWork in New York City with a simple idea: lease office space long-term, renovate it into trendy co-working spaces with free beer and kombucha, and sublease short-term to freelancers and startups. The timing was perfect. Post-recession Manhattan was littered with empty office buildings. The gig economy was exploding, and Silicon Valley had an insatiable appetite for anything that claimed to be disruptive. But Neumann wasn't going to pitch WeWork as what it actually was: a real estate arbitrage play. No, he positioned it as a tech company and a physical social network. He told investors they weren't buying office space. They were buying community. They were buying the future of work itself. And investors ate it up. By 2019, WeWork operated 850 locations in over 100 cities. Over 400,000 members used their spaces, including more than 1/3 of Fortune 500 companies. But here's where the story gets absurd. In 2017, Japanese billionaire Masayoshi Son, founder of SoftBank and controller of the 100 Billion Vision Fund, arrived at WeWork's headquarters for a meeting with Adam Neumann. Son looked at his watch and said, "I'm so sorry, but I only have 12 minutes. 12 minutes. That's all it took. Neumann gave Son a whirlwind tour of the office, showed him the communal spaces, explained the vision. And at the end of those 12 minutes, Masayoshi Son committed $4.4 billion to WeWork. His own due diligence team had warned him about the company's missed goals and mounting losses. He invested anyway. Over the following years, SoftBank would pour over $18.5 billion into WeWork, making it the largest bet in the Vision Fund's entire portfolio. And that money created a problem. Because when you give a company that much cash, you don't just fund it. You inflate it beyond any connection to reality. So how do you make a money-losing real estate company look like a profitable tech startup? You invent new math. In 2018, WeWork lost $1.9 billion on revenue of $1.8 billion. Read that again. They lost more money than they made. By any traditional measure, this was a company bleeding out, but WeWork's S-1 filing introduced Wall Street to something called Community-Adjusted EBITDA. This metric took standard EBITDA, which already excludes interest, taxes, depreciation, and amortization, and then excluded virtually everything else. Marketing costs? Gone. General and administrative expenses? Removed. Building operation costs? Adjusted away. One bond analyst named Adam Cohen read the document and said, "I've never seen the phrase community-adjusted EBITDA in my life." The Financial Times would later call it the most infamous financial metric of a generation. NYU professor Scott Galloway put it more bluntly, "You can't make this up." But the invented metrics weren't even the worst part. When Wall Street analysts actually read WeWork's S-1 filing on August 14, 2019, they discovered something far more troubling. Adam Neumann had structured the company so he could never be held accountable. Neumann held shares with 20 votes each, while ordinary shareholders got just one. This gave him majority control over every corporate decision, even though he owned a minority of the company. He was, in effect, CEO for life. Then there was the trademark issue. Neumann had personally trademarked the word "we." When WeWork rebranded to the We Company, Neumann charged his own company $5.9 million to use the name he'd trademarked. He was selling a word to himself, and perhaps most bizarre of all, the S1 revealed that Neumann's wife, Rebecca, who held no official position on the board, had been given the authority to choose his successor if he died or became disabled. Scott Galloway's reaction to the filing went viral. "You can't make this S up." And this is where private markets and public markets collide. In private fundraising rounds, companies negotiate valuations directly with investors. One deep-pocketed believer, like Masayoshi Son, can sustain a fantasy indefinitely. But an IPO is different. An IPO requires convincing thousands of institutional investors, analysts, and fund managers to buy shares at your asking price. These people read financial statements professionally. They spot red flags. They ask hard questions, and the questions came fast. Within days of the S1 filing, analysts were calling WeWork's $47 billion valuation absurd. The company wasn't a tech platform with near zero marginal costs. It was a landlord with massive fixed expenses. Its revenue grew, but its losses grew faster. Every new building cost more to operate. The market consensus was brutal. WeWork might be worth $10 billion. Maybe 8, maybe less. In September, the company cut its target valuation in half, then cut it again. The planned IPO price implied a value under $15 billion, an immediate 68% haircut from January. Then came the stories about Adam Neumann himself. Reports emerged of his management style, the kind that looked bold in a startup garage, but catastrophic in a public company. In 2016, when WeWork conducted layoffs, Neumann addressed the affected employees at an all-hands meeting. Employees walked in carrying trays of tequila shots. The meeting became a party. More damaging were the reports about his private jet trips. On one flight to Israel, crew members reportedly found marijuana stuffed inside a cereal box. The smoke in the cabin became so thick that crew members had to put on oxygen masks. For private investors willing to bet on a visionary founder, this might have been eccentricity. For pension funds and mutual funds considering buying shares in a public company, it was disqualifying. The S1 had done what private markets never could. It forced WeWork to show the public everything. And what the public saw was a company that looked nothing like its valuation. So here's how fast it all collapsed. August 14, 2019, WeWork files its S1. The document is 350 pages of red flags. September 17th, WeWork announces the IPO is postponed indefinitely. The valuation has collapsed too far to proceed. September 22nd through 24, SoftBank and WeWork's board meet with Neumann repeatedly, pressuring him to step down. September 24th. 41 days after filing the S1, Adam Neumann resigns as CEO. He's replaced by two co-CEOs, Artie Minson and Sebastian Gunningham, neither of whom have the power or personality to right the ship. September 30th, WeWork formally withdraws its S1 filing. The IPO is officially dead. 47 days. That's how long it took to destroy what had been America's most valuable startup. The company that Masayoshi Son had valued at $47 billion was now worth less than $8 billion. An 83% decline in 6 weeks, and WeWork was days away from running out of cash entirely. But SoftBank couldn't let WeWork die. Not with $18 billion already invested. In October 2019, Masayoshi Son approved a $9.5 billion rescue package. The deal gave SoftBank approximately 80% ownership of WeWork. The company that Son had valued at $47 billion 9 months earlier was now worth under $8 billion. And Adam Neumann? The man who had driven his company to the edge of bankruptcy walked away with one of the most lucrative exit packages in corporate history, up to $1.7 billion. That included $970 million for his shares, a $185 million consulting fee, and a $500 million credit line. Meanwhile, in November 2019, WeWork laid off 2,400 employees, roughly 20% of its global workforce of 2,500 people. The contrast was obscene. The founder who'd created the disaster became a billionaire. The employees who'd believed in his vision got cardboard boxes. As one analyst noted, the $47 billion valuation was always a private market construction sustained by one investor's accounting need rather than a market-tested price. And then, Masayoshi Son said the quiet part out loud. At SoftBank's May 2020 earnings call, amid record-breaking losses, Son told shareholders, "It was foolish of me to invest in WeWork. I was wrong." By that point, SoftBank had internally marked WeWork's value down to $2.9 billion. That's a 94% decline from $47 billion in just 16 months. The total damage? SoftBank eventually recorded $11.5 billion in equity losses on WeWork, with another $2.2 billion in debt still at risk when the company filed for bankruptcy. WeWork did eventually go public through a SPAC merger in October 2021 at a $9 billion valuation. But the COVID-19 pandemic had devastated demand for co-working spaces. Remote work became the norm. Empty WeWork offices became symbols of a business model that never quite made sense. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy. The company listed $18.65 billion in liabilities against just $15 billion in assets, plus approximately $100 million in unpaid rent to landlords. But the strangest chapter was yet to come. After 2 years of silence, Adam Neumann gave his first interview. His words were carefully chosen. "It was never my intention for the company not to succeed as much as it did." Not an apology, not remorse, just semantic gymnastics. And here's the final irony that makes this story impossible to believe. Adam Neumann, the man who nearly destroyed WeWork, who cashed out while employees lost their jobs, who left SoftBank holding an $11 billion loss, later attempted to buy back the company he'd demolished. The bid failed, but the audacity remained. WeWork's collapse wasn't just a corporate failure. It was a stress test for an entire system. Private markets that valued narrative over fundamentals, investors who mistook charisma for competence, governance structures that made founders unaccountable, and a media ecosystem that celebrated disruption without asking what was being disrupted. The $47 billion was never real. It was a number on a spreadsheet, sustained by one investor's willingness to keep writing checks. When that investor finally stopped, the number vanished, and so did everything that depended on it. So what does WeWork teach us? That a real estate company can be valued like a tech unicorn, until someone actually checks the math. That a single investor can sustain a fantasy valuation indefinitely until public markets force reality back in. That super voting shares can make founders untouchable right up until the moment everyone realizes they shouldn't be touched. And that the IPO process, for all its flaws, remains one of the only mechanisms that forces private companies to tell the truth. Masayoshi Son said it best in the aftermath. "Recently, I have been telling founders to know your limit." But Adam Neumann never learned that lesson. He walked away with $1.7 billion. He's still a billionaire. He's already working on his next real estate startup. The system that created WeWork hasn't been fixed. It's just waiting for the next visionary founder with the right pitch, the right timing, and the right investor willing to write a check after a 12-minute meeting. And the scariest part? We won't see it coming until the S1 drops.